Decades of manipulation just collapsed in a matter of weeks. The wall that held silver down for over 11 years finally cracked. Watch what happens when the most suppressed asset on the planet breaks free. For the first time since 2011, silver is trading at levels that were mathematically impossible just months ago. And it's not stopping here. This is only the beginning of something massive. If you've been waiting for a signal that something fundamental has shifted in the metals market, you're looking at it right now. Subscribe right now and hit the notification bell, because what we're about to reveal changes everything about how you should be thinking about precious metals in 2026. Drop a comment below telling us your silver price target for next year. The predictions in this chat are starting to get absolutely wild. Because once silver breaks through this level, nothing stops it until it finds the next major resistance point above $50. This isn't speculation anymore. The charts, the data, and the fundamentals are all screaming the same message. And we're going to break down exactly why this happened, how it happened, and what comes next. For decades, silver faced an invisible ceiling that kept prices locked in a cage. The $30 barrier stood like an impenetrable wall, touched and rejected time and time again across 15 years of market cycles. Institutional traders, major banks, and market makers seemed almost coordinated in their efforts to prevent the white metal from breaking through this critical threshold. Every time silver rallied toward $30 and touched $29.50 or $29.80, something happened. A sudden flash crash, unexpected volatility, or algorithmic selling that pushed prices back down below $28. This pattern repeated so consistently that it became almost mechanical, almost predictable. But something changed in late 2024 and throughout 2025. The supply-demand fundamentals shifted so dramatically that even the strongest suppression couldn't hold back the tide anymore. China began hoarding silver for its solar panel revolution. Industrial demand from electronics manufacturers, automotive companies developing electric vehicles, and renewable energy installations exploded beyond all historical precedent. Meanwhile, physical supply tightened to levels not seen in a decade, with major mining operations struggling to keep pace with this insatiable demand. The dam finally broke in a way that shocked even the most bullish analysts. Silver more than doubled in 2025, with spot XAGUSD surging past all historical expectations as momentum indicators climbed to their highest levels since 2011 Forex.com, when silver decisively closed above $30 and sustained those levels. Something shifted in the collective consciousness of the market. Suddenly, traders who had been short silver for years found themselves in losing positions. Fund managers who had written off silver as a sleepy safe haven asset began scrambling to position for the breakout. The psychological impact cannot be overstated. For over a decade, every person who bought silver above $30 had lost money. Every investor who held above that level experienced continuous frustration and red portfolio pages. The mental resistance to buying was so strong that even when supply indicators screamed bullish, traders remained skeptical. But once the $30 level was finally broken and held for days, then weeks, then months, the narrative completely inverted. Suddenly, silver wasn't a struggling asset being suppressed. It was an explosive breakout creating opportunity for the first time in 13 years. 4 pillars of this historic breakout. 1. The collapse of a multi-decade suppression mechanism. The most controversial aspect of silver's price history involves the persistent theories about price suppression by major financial institutions. The $31 level has served as a pivotal barrier with no yearly closes above it in the past 40 years. And historically, every break above $31 has been followed by a spike and a sharp drop until 2025, when sustained bullish momentum above $30 suggested a potential structural shift in market dynamics FX empire. What made 2025 different was that this time the suppression mechanism failed. The break above $31 didn't reverse as it had in previous attempts. Instead, it accelerated. The first sign of the breakdown came in the early part of 2025 when massive physical silver delivery requests began flooding COMEX warehouses. Industrial users, investors, and central banks started converting their paper silver contracts into actual physical metal. This forced the banks and dealers who maintained massive short positions to either cover at increasingly higher prices or face the risk of default. Once the covering began in earnest, it triggered a cascade of buying that overwhelmed all resistance. Algorithms and trend-following systems began detecting the breakout and automatically buying, which further accelerated the move. What's particularly significant is that this breakout was driven by fundamental supply-demand mechanics rather than speculative fever. In 2024, industrial consumption surged by 7% to over 700 million ounces, a record that's expected to rise in 2025 and beyond, with the renewable energy sector representing one of the fastest-growing buying sectors, with solar panels alone expected to consume 100% of the silver supply by 2050 SBC. Gold. This isn't temporary demand, it's a structural shift in how the global economy functions. As the world transitions toward renewable energy, silver becomes increasingly essential, not optional. The suppression that lasted so long finally broke because the forces of legitimate supply constraint simply overwhelmed the capacity of financial institutions to contain prices. For the first time, physical reality collided with paper markets, and physical reality won decisively. 2. Technical analysis confirms the structural breakout. From a pure technical perspective, the break above $30 followed textbook classical chart patterns that signaled a massive accumulation phase was ending. Silver showed a well-structured ascending triangle pattern in 2025, a classic bullish continuation signal, with volume confirmation and long candle bodies adding strength to the breakout argument, suggesting the price could easily surpass $50 and move toward untested levels around $100 and higher gold predictors. When you look at the daily, weekly, and monthly charts simultaneously, the pattern becomes almost undeniable. On the monthly chart spanning decades, silver had been forming what technicians call a massive cup-and-handle pattern, a formation that typically precedes explosive multi-year rallies. Silver broke out of a cup-and-handle pattern in 2025, projected to yield a gain of over 700%, similar to the 747% rally from the 1993 low to the $31 peak FX empire. The handle portion of the pattern had just completed, and the breakout was technically confirmed by multiple indicators. The relative strength index moved above 70 without showing bearish divergence, meaning momentum was accelerating rather than weakening at the top. Volume surged dramatically above average on the breakout days, indicating massive institutional accumulation. The resistance levels that historically contained silver now act as support. A technical breakout from a rising triangle established $76.35 as a new support level in recent weeks, with the RSI near 88, indicating strong buying pressure with no signs of bearish divergence. As silver prices moved toward targets at $81.30 and $82.75 FX leaders. Think about that for a moment. What was once considered an aggressive bullish target for 2026, the $50 level, is now just a pit stop on the journey to much higher levels. The Fibonacci retracements aligned perfectly with the psychological price levels, creating confluence zones that technicians have been watching obsessively. When price action respects mathematical ratios developed by 14th century mathematicians, it suggests something deeper than random market movement is at play. The precision of these technical levels suggests that the move higher is structural and deliberate rather than chaotic or speculative. 3. The $32.50 level and what it means historically. The $32.50 level that silver recently conquered carries enormous historical significance that most casual observers completely miss. Silver's monthly RSI, climbed to its highest level since 2011, while the price moved decisively through technical resistance, with the broader outlook remaining constructive as momentum continued to build with no signs of weakening. Forex.com. The 2011 peak at $49.82 represents the last time silver attempted a major breakout toward new highs. Back then, a combination of speculative buying, margin expansion, and institutional accumulation created a perfect storm that pushed silver to levels many thought impossible. But 2011 failed. The rally collapsed spectacularly, leaving silver investors devastated for over a decade. Prices plunged back below $30, then kept falling toward $15 in 2015. All the gains were erased, and then some. Investors who bought the 2011 peak didn't recoup their losses until 2025, 14 years later. This historical failure created deep psychological scars in the market. Whenever silver approached $30 in subsequent years, traders became extremely cautious, remembering what happened before. The fear of 2011 repeating prevented aggressive buying even as fundamentals improved dramatically. Breaking above $32.50 in 2025 is therefore extraordinarily significant because it means silver is now trading at levels that haven't been sustained since before the failed rally of 2011. This time, however, the situation is different. The fundamentals that drove the 2011 rally were speculative and unsustainable, margin buying on leveraged accounts, creating an artificial bubble. Today's move is driven by actual supply constraints and genuine industrial demand that will remain in place for decades. The 11-year high designation becomes a psychological milestone that attracts attention from investors who were burned in 2011 but have been waiting for a proper second chance. These investors remember exactly how far silver fell from the 2011 peak and are now determined to take profits on the way up this time, rather than hoping for continued rallies. Their presence creates additional buying interest as they re-enter positions they abandoned a decade earlier. 4. What this means for precious metals in 2026 and beyond. The breakout of silver's suppression wall doesn't exist in isolation. It's part of a broader recalibration happening across the entire precious metals complex. Gold has already established new all-time highs above $4,500, and platinum and palladium have also participated in this broad-based rally. But silver has outperformed all of them dramatically, which tells us something critical about where smart money believes the real opportunity lies. Silver's trajectory shifted decisively in the second half of 2025, with prices accelerating sharply and breaking through the historic $50 per ounce's resistance level that had capped silver rallies for decades, forcing analysts to rethink how high a silver squeeze could go. SBC gold. The consensus is shifting from debate over whether silver could reclaim 2011 highs toward discussion of whether it will reach $75, $100, or even higher. Major banks and research firms are recalibrating their forecasts practically weekly as silver continues to surprise on the upside. The gold-to-silver ratio remains one of the most important indicators for understanding where we are in this cycle. Historically, this ratio has averaged around 60-1 over the past century, meaning it takes approximately 60 ounces of silver to equal the price of 1 ounce of gold. Currently, the ratio sits near 82-1, which means silver is trading at a massive discount to gold on a historical basis. The breakdown in the gold-to-silver ratio supports continued outperformance of silver relative to gold, with the setup favoring continued upside in 2026 toward a $100 target FX empire. What this means practically is that silver has significantly more room to run relative to gold. As long as the ratio remains elevated, every ounce of gold appreciation will create additional pressure for silver to catch up. This mathematical relationship suggests that even if gold merely consolidates and doesn't advance further, silver could still double or triple simply through ratio compression. And if gold continues rallying toward $5,000 or higher, as many analysts expect, silver could be dragged along with massive upside. The industrial demand side of the equation provides a floor underneath prices that precious metals dealers have historically lacked. Previous precious metals bull markets were driven almost exclusively by investment demand and monetary policy fears. This one includes genuine production demand from manufacturers who need silver to function. The AI-driven rally has amplified the importance of silver across key industries, with demand remaining strong, supported by its critical role in the rapidly expanding solar sector, medical applications, and modern electronics. Forex.com. Even if the investment community turned bearish overnight, manufacturers would still need to accumulate silver to function, creating a permanent bid underneath the market. The geopolitical backdrop continues to deteriorate in ways that typically benefit precious metals. Tensions between major powers, currency warfare concerns, and central bank policy uncertainty all push capital toward hard assets. The U.S. dollar appears vulnerable to longer-term structural decline as the U.S. federal government struggles with debt sustainability. Alternative currencies and hard assets naturally become more attractive as dollar weakness persists. Silver, as both an industrial metal and a store of value, benefits from this dynamic in ways that most assets cannot. Looking at the market structure, what we're witnessing is genuinely historic. The combination of a structural supply deficit lasting its fifth consecutive year, exploding industrial demand driven by energy transition, ratio compression toward gold, geopolitical support for precious metals, and the successful breakdown of a multi-decade suppression mechanism creates a convergence of bullish factors that rarely align simultaneously. The $32.50 level that silver just conquered represents far more than a price point. It symbolizes the failure of forces that held this metal down for over a decade. It marks the beginning of a new era where physical supply constraints will finally drive prices higher sustainably. It demonstrates that the technical structure remains intact for further advances toward the $50 level and beyond. Most importantly, it signals to every institutional investor, hedge fund, and portfolio manager on the planet that the time to accumulate precious metals has arrived. This breakout is not a temporary spike that will reverse when profit takers emerge. This is a structural shift driven by forces that will persist for years. Supply will remain tight because mining companies have underinvested during the years of suppression. Industrial demand will continue accelerating because the energy transition is nowhere near complete. Central banks will continue supporting precious metals as they diversify away from dollars. And investors will continue accumulating because the asset class finally offers returns and protection. The resistance that was supposed to contain silver at $30 didn't hold because the forces pushing against it were simply too powerful. And the resistance levels ahead at $40, $50, $75, and beyond will be overcome in the same way through the inevitable pressure of supply scarcity meeting insatiable demand. The suppression is over, the breakout is real, and the opportunities ahead for investors who act decisively are potentially extraordinary. Subscribe now to stay updated as this precious metals revolution unfolds, because each resistance level broken creates new profits and new milestones in what will likely be remembered as one of the defining asset rallies of this decade.